Hello, welcome back. So in this video we are examining AT&T, very well known telecommunications company. It was suggested by one of our subscribers to take a look at this one. This is a massive company which doesn't move very much in terms of its stock price, a very old IPO. And let's examine what the company has been doing financially. Now, as you can understand, this is a dividend paying company, and obviously it's worth examining, and it can be a nice addition for a portfolio right now. And the reason for this is that it's paying a pretty nice dividend over here, as you will see. And the thing is, when you are in the middle of an inflationary period, getting some extra income in the form of dividends may not be as bad at all as one could possibly think about, especially when we're talking about low interest periods. But right now, as we are having more inflation, higher interest rates, it may make a little bit of sense to actually add these kinds of paying stocks pretty much in your portfolio. And if we take a look at the 5-year chart, you will see that the company has been up and down in a range pretty much. So right now it's for the most part in the lower range, which means that it could potentially climb a little bit as years progress. But for this kind of company, you should not expect too much in terms of the stock price. I mean, you can kind of see it here that it has been going up and down a lot. It's not really explosive. But again, this is a company that is paying a hefty dividend. It's mostly about you making some income really, and not gaining this explosive growth that you can gain from some other opportunities. That doesn't mean that it's a bad stock, of course. Now, we do want to examine the financials and see what's going on with this one, and maybe it's a potentially interesting buy. Now, the PE ratio is sitting at 8.7 here, and the price to free cash flow ratio at 5.8, which is absolutely fair. Now, of course, remember these kinds of companies, because they are not growing that much and they are sort of like stable companies that make some stable income, we're not expecting them to have high PEs or high price to free cash flow ratios. They tend to be trading at lower multiples than its counterparts that are doing technology, for example. These are much more growth potential companies, and so they are trading at higher multiples. So this one is also issuing a little bit of shares here, but not too many, just 5%. I wouldn't have too much trouble with this one. It's just a 5-year 5% gain, not a huge increase in the float. And the total liabilities, they seem to be quite a lot here. Maybe the company has quite some debt. We will examine that. But you will see that the net income has been going down as well. And this is not a pretty sight, of course, 30% almost since the last 5 years. It hasn't grown, it has actually shrinked, and that's something that I don't like to see, of course. Now, the 5-year revenue growth has been increasing a little bit, but again, you cannot see it in the net income. And the total equity has been going down as well. A little bit of extra debt compared to equity, not too massive though. And net income margin is actually higher than I would expect, to tell you the truth. 10% is not bad at all, and return on equity is also 10%. You will see here, though, that the dividend yield that the company is paying is 7.5%. This is the 12-month one, of course, and you have to be a little bit careful about this one, because if we take a look at the dividends module here, which breaks down exactly what is happening here with the dividends, you will see the increase, and you will see that the last 12-month dividend yield has been 7.5%, but that's because of some special dividends that were paid. And our tool here can actually tell you what is the effective dividend yield based on the price that you're seeing right now. And it is here in the key metrics dividend yield. As you'll see, this is the current dividends paid in relation to the current stock price. And so now if we go back in our stock analysis chart, you will notice that our free cash flow payout ratio and our payout ratio here are a little bit elevated. But again, this is about the 7% that you see here, for example. And so if you calculate this for a 5%, you're probably getting a lower ratio here. And so these are probably fine. These are probably going to be more than likely less than 50%. So I wouldn't be too troubled about the dividend being paid from this company as it is right now. Now, take a look at the income statement here. You will notice that the revenue hasn't increased much. It's about the same since 2017. Again, this is why this company doesn't really deserve a higher multiple, as you can understand. It's all about making a better balance sheet, really. 29 billion to 20 billion net income has been going down, and they even had the negative one back in 2020. So these are not great things to see, of course. What I do want to kind of take a look at is the retained earnings here, which seem to be going down. 58 billion to 42 billion. Now, this could be, for example, because of paying the extra dividends and all these things. But the thing is, it is going down in terms of the cumulative effect of net income here. Something interesting to spot. And you will notice that the total liabilities of the company are sitting at 367 billion. That's a lot, of course. Yet the total equity is sitting at 184 billion. So 367 billion of that's the total liabilities. And if we take a look at the long-term debt, is about 174 billion. That's a lot of debt, of course. And taking a look at the cash flow here, you will see that the company makes just 25 billion here. So just paying back the debt would take some time using this current free cash flow. Now, do you really care about this too much? Well, you could say that you want to basically milk the cow here and get the dividends out of what they are paying, and it seems like they can pay the dividend comfortably. But I don't really want them to keep on amassing more debt here, because debt at some point will come back to bite you if you're paying too much interest on this one. So I do want them to alleviate a little bit of debt. It looks like they're getting more and more, and that's not great to see. And if you take a look at the net cash used for financing activities here, you will notice, for instance, that they still got some extra debt here, and they only paid half of it, or less than half of it. Last year they actually paid more of it, but overall it's balanced, so they haven't made too much progress here. Granted, yeah, in the previous years this has been better, but take a look at 2017. So they are basically sitting at similar amounts of debt. We can kind of also take a look at the balance sheet here, which kind of shows us how debt has progressed. You will see long-term debt here, 166 to 174. So they don't seem to be paying any of it back, they seem to be increasing it. They did pay a little bit here, but then they amassed more. So I'm not a big fan of this one. I want less debt. So the total debt sitting at 200 billion here. That's a lot. Yeah, that's a lot of debt. I would really hope that they actually pay back some of it, because eventually, as I said, it will come back to haunt them. Now, with this risk in mind, let's take a look at what to pay for the company. Now, the revenue growth has been pretty much in 0 to 1%, something of that sort. So I will have to go low, 0. Let's just say that the company doesn't grow anymore. 0, 0.5 and 1% is what we're going to try. The net income margins here are about 10%, 7%. I'm going to go in between. Let's go 6, 8 and 10. Free cash flow margins overall 126, 117, some odd ones over here, odd ones out. But overall I think I'm gonna use maybe 90, 100 and 110 for this one. 13% for our annual return. Let's see what we're getting out of this one. Now, okay, the current price of 20 bucks, 21 bucks is actually a buy right now for our medium estimates of just 0.5% revenue growth, which has happened. This is what has been happening in the last 5 years on average. And so the net income margin of 8% has also happened. It's actually 9% in the last 5 years. So if the company continues its trajectory as it's going right now, this company is a buy. And you do have to bear in mind that you have this extra risk because of the debt. Yet you are getting paid 5.5% or so of a dividend yield every year. So it would take you about what, like 15 years to get all your capital back in the form of dividends, I suppose. Now, if I add 15% for my annual return here, just because I have some extra risk because of this debt, let's just say that I want to get 15%. Now we are still in the green, but with a lower price, and our low projections here are even lower, and so we are in the red even more over here. So overall, I think this company may be a nice addition to a portfolio, with the added risk that it has some extra debt that I would like them to alleviate. But the thing is, they are paying some nice dividend, and it looks like it's relatively safe here. So I think that for at least this kind of period of time, at this current price, which is relatively low, it could be an interesting case for a buy over here. But do leave a comment and let me know what you think about AT&T, and remember to leave a like and subscribe in the channel. That really helps, and you can stay tuned with what we're doing here, a lot of stuff. And also remember that you can actually get access to this tool, gain access to this tool by becoming a patron. You can find links in the description box below this video, and also you can join our Discord channel. We'd love to see you there. All the links again in the description box below, and I'll see you in the next video, guys. Have an awesome day. Bye bye.